traffic and the driving. Oof, it's rough.
All right, good evening, guys. Ken at Tortoise Capital. Let me see. Yep. This is small group coaching cohort 1 for November 11th, 2024. Happy Veterans Day to the gang out there. I listened to a good video this morning. It was a recording from a British artillery headquarters in 1918. And you could hear the sound of the artillery guns being fired right up until 11 o'clock in the morning. And then it all stopped. Armistice. And about 10 or 15 seconds later, the birds start chirping. It was the most surreal, gratifying tribute to nature you ever heard. It was amazing stuff. For my check-in, I uploaded a couple videos from yesterday morning. One of them talks about the AI 2025 project. It's already better than what I already briefed in there. But what I briefed on Sunday morning yesterday is still pretty good. I get a blank check from our 3-star general to do whatever I want to do to create coaching personas with AI tools that'll help us accelerate our learning as military officers and as to improve our decision making as planners. And my plan is working with this CEO out in San Francisco who's got a company that does that, and to try to understand his process in order to replicate it with Army tools to produce Army coaches. And I'm going to be comparing that to the way I do it in order to sharpen my own tool. Iron sharpens iron. And then I listened this morning on I did a little 10-mile road march this morning to get ready for my, I had my annual checkup with my cardiologist today, and I needed to lose a little weight and drive my blood pressure down. So I did a 10-mile road march this morning and took my CBD tablets. That chills me out, and a cold shower. So everything was good. Clean bill of health on that. Cholesterol's LDL's under 100. Blood pressure was 120 over 80. Resting heartbeat was 60. The valve is performing perfectly. And he says, so that took about 2 minutes, and then we spent 10 minutes BSing. And, I don't know how many guys he gets to talk to like me, and it was kind of a nice break for him. I asked him what he was doing on why he's working on Veterans Day. And he says, well, I was up at the VA hospital in Leavenworth this morning doing some volunteer work. And so I came down here to handle the office calls. And that's pretty good. When the senior cardiologist in the state of Kansas is your cardiologist, and he's volunteering on a national holiday to work at the VA, I mean, in pretty good hands. So the executive summary from Friday morning's or from Sunday session, right? So Notebook LM by Google actually looks like it's going to be a tool that we can use to create personalized reference data that it can then analyze and summarize and illustrate and basically use a large language model plus what's called retrieval augmented generation, where you do the power of an LLM for reasoning, but you use a very focused data set to override the LLM training to keep it anchored inside a reference library or a corpus of work. So that's what I'm going to actually be doing with that AI company out in San Francisco. They're called relative.ai, relativ.ai. I'm going to give them a specification for what I want to see in a coach for the Army officers, and then they're going to build some kind of tunable, responsive tool that works with each individual, analyzes the ongoing conversations, and then steers it in the direction that that officer needs to go compared to the reference model of where he should be going. So it's going to be a dynamic dialogue analyzer. Well, it looks like Notebook LLM, which I haven't used yet, but it looks like it does that. I do that already with a large language model and um, a tailored prompt that has been trained in the same way that an RAG would, or that Notebook will do that. So I'm going to be comparing their process to my process to Notebook LM, and the bottom line is we're going to be able to. I told that CEO, his name Arjun. I said what I have is about 2,000 hours of coaching audio. That goes back about 15 years. That includes pre-COVID, during COVID, and after COVID, and a pretty extensive reference model of my books, writing, speeches, slides, coaching sessions. And from that, his software, I believe, is going to be able to derive a coach that is skilled in the way that I coach. And we're going to try to create that as a persona that you can then engage with. The idea being that as you perform a session of coaching, we're then going to have the AI analyze that, create an artifact that summarizes it, and then add that to the local reference body of knowledge so that as you work through sessions, that thing gets more and more tuned uniquely to you. So I'm thinking of this as a multi-layer RAG, where you start with a broad LLM for reasoning. You create the first order RAG, which is all the technical specs that we want you to master. And then a secondary RAG, like a turbo, in which your personalized conversation takes place. So I want you to imagine 20 guys being coached on their research models that are coming from a common framework. And then each individual is exploring in their own way. And as we find good things in one, those immediately get distributed to the other 20. It works exactly the same way as a limited liability corporation does for risk pooling. You get 20 different independent little scouts. If any one of them finds the treasure, then they all equally benefit from the treasure, but the risk is carried only by one individual, or the investigation is just one individual. So you minimize the cost of research and you maximize the value of successful research. That's the essence of the community of practice that we're assembling. And by deliberately incorporating, longer term students into the program to be course managers and all that, we're setting the conditions to have a very robust program going forward that doesn't rely on me to run the whole thing, but where we get course managers that are managing a research team of insights. My intention is that we get this thing going for another 50 years minimum, and we'll see what happens after 50 years. I don't know, but that's sort of the plan. I got a warning on that a year ago with the heart attacks. That I need to be more robust on that. So been working pretty hard on that really the past 15 months to get that established. And I think we're there. And then the tools from AI are really going to now start allowing me to leverage that gold mine of the mountains of individual work that we've been doing. I mean, I got hundreds of pages of written FAQs, thousands of hours of coaching. We ran a little test fire with that with Phil and Griff. They did their Owl Bundle users group meeting last night. I sent them a link to Notebook LM. They just dropped the slides and the audio into there, and it produced an 18-minute summary of their working group and it's the most persuasive advertisement for what we do that you've ever heard in AI generated dialogue, pseudo dialogue. I mean, it is astonishing how good that is. So, good news, AI 2025 next year. Got a lot of things on the getting put on the barbecue there and in the slow cooker, and it looks to be very promising. Looking forward to the year ahead. So that's sort of my check-in. Yeah, I had a chance on Friday after the general gave me the blank check and that CEO worked out how we're going to work the AI coaching development. I had a chance to spend an hour in a true storytelling session with a guy named Michaela Guarini, who is also a true storyteller practitioner, like me. And he was the assistant coach for AC Milan, one of the top 5 soccer clubs in the world. He was the assistant coach for psychology and high performance for 10 years with Carlos Ancelotti, one of the legendary coaches of the game. And at the end of that hour, he made a commitment to fly over to Fort Leavenworth and bring their tool set and work with me on doing some research with our Army officers to see how we use their self-awareness and psychology tools to improve decision making under stress and build in resilience. So naturally, I'll be figuring out how we can use that ourselves. So Friday was a pretty good day at work for me, I'll tell you. The long version of that is on the. I've already posted it in our courseware. I'm going to let you listen to the whole thing. It's pretty cool. Anyway, that's my check-in, and let's go ahead and go. Sandeep's not going to be able to make it tonight. He's taking kids to the airport. So let's do a check-in and get her rolling.
All right. I can go.
Great. Fire away.
So yeah, Friday was an incredible day for me as well. Everything was green. Whatever I did, it came out green. I continued to run my DIA system, and that was outperforming. So that's kind of my status on that. So this is how it's looking. My stats. The stats are still up. There's slippage, 0.37 to 0.27. But I still have a 1 to 2, and in the profit factor 192 and 160 on the real life. Pretty happy with that. Not too many trades though. It doesn't trade every day, and I haven't been able to find where else can I apply it. And I know, Ken, that we talked not that I was going to do this privately, but I want to share what I've been doing, not to leave this behind completely, but I want to share this and ask a couple questions. Where are you? All right. So I started experimenting with removing volatility out of the picture. So I started playing with the boxes, with the Darvas boxes.
Yep.
And as I did that, I started realizing that no matter how I aggregate the data, the RLCO patterns repeat themselves. And so if I could trade lower volatility with the RLCO, I can expand the rules to make them work in more places. Because the problem that I was having was that volatility, intraday volatility, was making me impossible to reuse the same set of rules everywhere. So I started with the SPY, and I started working through it, and I ended up testing the methodology with the Renko bars.
Yep.
I had used the Renko bars in the past without any success because I didn't understand how they worked. I didn't understand really the reason why I use them. And I started playing with it. And at the beginning, I got many bugs on the application because where the bars close and the highs and the lows and the size of the bricks. And then I started drilling down using range stat, a fraction of range stat as the brick size. So 3 bricks per R10. And I started experimenting at that level, and the results were unbelievable.
Let me clarify. You're making the R10 into 3 bricks,
Correct.
so it's really 1/30th of a range stat.
Correct.
Okay, clear.
And this is the reason, because in Rencos, you need every single bar takes 3 bars.
Yeah.
The current range, 1 range up or 1 range down.
Yeah.
So if it's that complete thing is an R10. The minimum risk you can take is 2 bricks. So I started playing with that, and I ended up applying the RLCO. So just briefly here, the yellow, thick yellow is the VWAP. The colorful here is the R90 with the MACD, and the dragon and the PSAR. The PSAR I went to 14, and wherever I put this thing it's kind of a monster, but you have to deal with the size of the bricks. That's the trick. So this is the SPY, and this is the graph of the equity line of the SPY. And the numbers are like this, right? A profit factor of 1.6 and a 2-to-1 in 6 months in 1,200 trades. And it stays like that. If I try DIA, it's going to be the same. And here I was experimenting with KRE to have something completely opposite or that trades differently. And profit factors are not that high, a little lower percentage of winners, but the 2-to-1 is right there. What I have been having issues is with my risk reward formula. Like, I've been experimenting with the pivot lines with no good results there. I started using the VWAP now with much better results, but it's only for regression to the mean. Like this day, this was Friday. Come on.
Yeah, so like this move that comes back to the VWAP.
Correct.
And this move here.
Yes.
Gets you back to the VWAP. Now, it's not unusual to see the size of this move back to the VWAP go one more. So I usually that's where you get your 2 legs. And like on this one, if there'd have been more time during the day, the thought would have been it would not have been surprising to get down all the way to here. So it goes up this far, it comes back here, and then it goes that far and then comes back. So you normally think of that as the size of the excursion is one leg. It goes up 1, comes back 1. At this test, it's not unusual for it to go down 1 and then come back. It did that here because there was enough time. So that's how the reversion to the mean works in that way. If you go back far enough, like if I'm here, let me go. Stop right there. That's good. That gives me room to draw. Just go ahead, stop right there. So if I'm right here, and the VWAP, the move has come right back to the long-term VWAP right here. and I'm trying, and it's starting to move out away from the VWAP. And I wonder, how high can that go? One of the ways I like to do that is go back to all previous excursions away from the VWAP and say, that's how far it went on the downside each time. 1, 2, 3, and 4. And then maybe a couple times it was up here and like that. So if you go back and you find the size, the absolute value of the moves away from the VWAP in the past, you can actually, that gets represented as a histogram. And then you can say, here's the average size of the move away from the histogram, and then you can go out one standard deviation and you say, oh, that's how far this thing can move before it becomes abnormal. It gives you a way to compare the strength of the traders versus the strength of the buy and holders. I normally think of the traders is the move away, and then the holders are the guys that are just holding, the VWAP. So whenever the RL10 is right around the VWAP, then both the traders and the holders agree that that is the fair price. It's right on the line. They say, all right, it started to move out this way. How far can that go? Well, if you've gone back and you'd studied all of the previous excursions away from the VWAP, like this one got that far, this one got that far, this one got that far, you start looking at the size of that as a percent move away from the VWAP. This measures how strong the traders were before they stopped. And then you get the reversion back to the mean, or in this case, the reversion back to the VWAP. What that allows you to do is sort of have a calibrated set of steps. You might say this one is the average. This one might be average minus 1 standard deviation. This might be average plus 1 standard deviation. Now, as this thing starts moving out, you say, oh, this looks like it's starting a move. It just made the average move. That's good. Now it made the average move plus 1 standard deviation. That's sort of in the same way that the range stat is the maximum reasonable. This is the maximum reasonable move based on previous strength of traders. And then if it gets to any one of these measured levels and starts to fail, you just take a 1, 2, 3 exit and say, okay, it was that kind of a move. Because if you look back over time, you say, hey, this thing moved like this, and then it moved like this, and sometimes it's only this, and you start getting the size of the mountains, the movements away from the VWAP. What makes that interesting is that the VWAP is not a horizontal line. It's always, if you had a strong upward trend, the VWAP is always moving up. So whenever it starts the next move, it's always starting at a higher level than it did the last time. When the VWAP rolls over and starts to change, now you say, that may have been the end of that multi-day upward move. Now the size of the traders, or the power of the traders to move it, I would now expect to see them trying to push the thing down. Or if it was a kata 2, it pulls back, and now they want to move higher. So here's how I use that when I'm thinking about the kata 2. You have a multi-day move that was up in here, and everything is good. And then it makes a little measured kata 2 and starts that second mouse action. So now what I can do is I can say, if this is my stop, because now it's going to be a collapsing dragon, I can now take the previous peak and say, well, there's a technical level that will act as resistance because it acted like resistance here. But if it breaks above that, now I can take the size of those projected moves and start building upside potential before the traders get exhausted. I always feel like it's the first mouse that made it turn. The second mouse is getting in here. The third mouse gets in after confirmation that it's making new highs. The fourth mouse gets in because he's just in despair that he's missed that whole move. And then finally, the fifth mouse gets in because there's such a safe distance that it's already moved. He finally gets in, and now there's nobody left to buy it. And then right after the fifth mouse gets in, the guy who was waiting for the most confirmation, now it starts to fail. Well, if that was the story of that move, I could then just go from here, from that turning point, the last time the RL10 moved, how far does it go to the next time the RL10 rolls over? Or from, if I'm using the RLCO pattern, the RL10 does this. And now if I'm using that in conjunction with the RL30, I say, hey, the RL30 is slow. Now I can start measuring from P1. Okay, it reversed, it crossed the RL30. Now it peaked, and now it confirms by crossing the RL30. I can now start measuring that move. How big is that move? And then this is how much of that move am I giving back? And then on this one, how much did I not get because I was waiting for the confirmation of it? So if the how much time I'm waiting is A, and the amount that I'm getting is B, and the amount that I'm giving back is C, you know, A plus B plus C is the total move. The maximum move was from here to here. And B is what I'm capturing. So what's my percentage of the total move represented by B? Now, if I want to increase the efficiency of my capturing of the total possible move, then I have to start figuring out how to enter a little bit sooner and then exit a little bit sooner. So maybe instead of waiting for the crossover or waiting for it to come through the dragon, maybe I take a 1, 2, 3 entry and get in here, because if it fails, I'm into the collapsing dragon anyway, so I'm fine. But if it works, I get the little earlier entry. If I get an earlier entry, I'm usually willing to wait for this RL10 to roll over and then just take the skin of the dragon as my stop on the upside. That's usually better than waiting for it to come all the way back to the RL30 or the PSAR, because the PSAR is cruising along up in here. So we think of that as that jump stop. So well, I say all that just to remind ourselves what that architecture of the RL10 defining the turning points of price, and then using the slower RL30 as the confirmation, the PSAR being some measured move. And again, if you're doing this intraday, the idea of the VWAP being in there, now suddenly if this was the VWAP, you know, it sold off and now I got this move, it's above the VWAP, now I have reasons to be positive emotionally. Then it's the size of, one way to look at this is the size of the move, the VWAP stretch that day. How far is it going to move back so that the end of the day guys can settle up near the VWAP? That's the VWAP magnet trade.
Yeah.
So if I know how strong all the previous moves away from the VWAP are, I can tell you if this initial surge is really great or not. Hopefully I can get pieces of this. But once it rolls over, I got to learn how to just accept my win gracefully. And now, is there enough of a move on the way back to the VWAP to justify that move? So if you watch cohort 2 with Jay and Kevin. Jay is a pro money manager who is using SPX options. And in the last half hour of the day, in that last 30 minutes, when I'm normally not trading, here's the close. He is getting really good trades from a reversal that comes back to the VWAP. It was a strong move this way, and he's able to get some options plays in the last 30 minutes using his mojo, and he's crushing that move. Or it could have been an upward move, and it reverts back to the VWAP. So that's an actual thing that, like this move here, hopefully you got that when it was a breakdown below the collapsing dragon. Hopefully we got that. But intraday, when that reverses and gives you a 1, 2, 3, there's your VWAP magnet trade, just like magic. So the work that you're doing in this area is solid and very helpful. And now Jay says, he keeps looking at it, says, can it really be that easy? It looks too easy. And I got to remind him that we have a setup and a mental framework that's looking at that market in a unique way. How many people are using the RL10 for price, and how many people are using the VWAP as the target? I don't know. But it's marked off on our charts, so it looks really easy. But maybe it's easy because nobody else is using that same particular lens. I don't know. That's one of the reasons we like to do our own research, is because we have a chance of creating a unique point of view that other people aren't acting on. All right, back to you.
Okay. So, okay, that's awesome. I'm going to concentrate on expanding on the VWAP. As you were talking, I started thinking that maybe I'm going to gear, at least as a test initially, to use the VWAP as my main thing. So for example, this exit could have happened on the break on the VWAP and coming back up, instead of dinner for two, losing a bunch of move here. So I'm gonna look into that. The second observation I've had on here is that it seems that the value that people, or the RL270, which is the purple line here, it's like a magnet as well. Like it always tends to be there. If you notice this trend, it's just stayed next to it, and it happens. It's like it's a pattern. If you look in time,
it's the direction of the long-term buy and hold projected forward, and then you just notice that the RL10 and 30 combo is oscillating around that. Now, when it goes to here, this was the first time off every one of these other little rebounds. Every one of those little rebounds ended up crossing the RL270. So after this low, you get this cross. After this low, you get a move above. After this cross, you get a cross back up. You get this one, you get that one, you get this one. Oops.
Steve,
it did not cross above here. Now suddenly, notice what happens on the daily VWAP, and there's your first signal. It now reversed, crossed below the VWAP without making a new high. That's an alert that the downside is coming. And then the second alert is when you have the actual price structure of the collapsing dragon. So that's your first warning right here. Then it crosses the VWAP. That's the second one. And here's the third one. That's the crossing of the collapsing dragon. And you still get this move, even if you waited until signal number 3. But you could have actually gotten that one at signal number 2 when it crossed below the VWAP and gotten that whole move. So we're really watching two things on there. We're looking at where the RL 270 is projecting. In one sense, that acts like a reversion to the mean trade. Like every one of these that goes away and then comes back. One of the things that we can use as a mean or a surrogate of the average that it's going to return to is the RL 270. Another one is the VWAP itself. Another one is the 30-period moving average. So when we say reversion to the mean, I actually, the reversion to the mean, it can actually be an average like the Bollinger Band mean, which is the SMA 30. But it can also be the VWAP of today. It can also be those anchored VWAPs. And as you know, I look at the 3-day, 5-day, 10-day, 30-day, 150-day because of the sniper. Each one of those represents a return to a normal price for a much longer look back period. So the reversion to the mean trade is central to the way that I'm looking at the market here. And I'm not just considering one definition for a reversion to the mean. I mean, there's 7 or 8 things. And each one of those represents, after a move in one direction, there's probably some ladder of reversion to the means. Each one of those is a reasonable target as you go down. And by the fact that you have them there, you can calibrate the next reasonable move. And you can look at all those as certain, chunks or legs or bricks. Now, if you have your R10 calibrated size, you can now start expressing those legs as units of risk and therefore units of reward. And that gives you a dynamic way of calculating ongoing reward to risk ratios. And then the other thing I'll just point out is, like, this one was so important. Notice what happens here on your little MACD.
Yeah.
It makes a lower high. It did not get through the Red River. All of these did get through the Red River. This one did not. That tells you this is the end of all this upward goodness. That's warning you that, man, signs are pointing to a reversal. Right there. Confirmed when it crosses into the winter right there. And then that gives you entries to the short side somewhere around in here. Those things add up.
Yeah.
There's a lot of moving pieces on that. But and now notice how you can see the RL 270 is starting to roll over.
Yeah. Let me make it a little smaller.
Yeah, go ahead.
To see more data.
Yep.
So yeah, what I've seen is it always chunks to the RL 270. Come on.
Yeah.
There.
Yeah, that 270 has real power. You know how many out of the 500 million traders in the world, how many of them use the moving 270 regression line?
Yeah, I know.
I don't have no idea. Not many. I'm gonna bet not many.
Yeah, it's seen as a very long-term thing.
Yeah. And remember remember the fractal nature of that thing, that it's working inside the 10, the 30, the 90, the 270, that's our fast pair. That's our slow pair. And it's the difference of the outer two. This is the fastest fast traders. This is the slowest slow holders. The difference in opinion between those two is why there's a trade. When they're both moving together at the same price, the 270 and the 10 are together, they both agree that the current price is fair. And then the traders take it a certain distance, and then it starts reverting back to the RL 270. So now you have a way to calibrate how much reward is there on the move back to the 270, or intraday, the VWAP. And where is if the VWAP is on the far side of the 270, that's even better, because now I have more reasons to believe it can come back to the 270, because it's really going to come back to the VWAP. And then at the end of a long run, like you just showed, if the 270 is projecting to be way up here, but the RL10, which has been going above and below and above and below and above and below, and now doesn't get above and now starts breaking down, that's where the collapsing dragon is really strong, because you have a lower high. You have a lower high in here that creates that first divergence, and then that's the confirmation of price collapse, that now it's going to do that. And that's what you got up in here.
Yeah.
Okay, back to you.
Thank you. No, this is it. That was my question, and I'm gonna focus on working the VWAP and probably adding the standard deviation up and down, and see how I can continue filtering that way for now.
There's actually, since you're a programmer, if you could create a little indicator bar that had the RL 270, no, the RL10 minus the RL 270, and make that the two inputs for an MACD, you'd end up seeing like a zero line. And then when you saw the spring, you'd be all over it, because it's going to revert back to the 270, and it might shoot past it all the way up into here. So see what you can do about creating a MACD with the RL10 minus the RL270, and then have that'll tell you how big in reference how big those oscillations are.
Awesome. Thank you. Thank you.
I got to see if I can do that in TC 2000. I do that on the daily charts anyway, by the way, with my what we've really just discovered here is the regression line fractal framework. On the daily charts, literally, what I do is I take the RL 270 is here projected, and I just say, here was the last time the RL10 was there, and now the RL10 went down here and has started to reverse. I just count the number of ATRs between the RL10 and the RL270. And that's my 5-to-1, in that case, a 5-to-1 reward to risk, just on the daily bars. I do that all the time. Standard work.
That's awesome. Oof. All right.
By the way, the work that Phil and Griff did is they just did one this last week, that when the Z-score, the MACD Z-score, when it goes down below -2 and then starts to reverse, and the red river is, here's the zero line, and the red river is like right here. So that tells you, as soon as it does like that move, there's your SSC. Using daily bars, they went back 20 years, daily bars, and found every place where the MACD z-score was worse than -1, but the slope was rising. That means it's already made this little hook. They just bought it. And then they said, let me project forward 5 days, 10 days, 20 days, and 30 days. And where is price those in those forward days with no other rules? And that has about a 70% win rate.
Yeah.
And the average win to the average loss is like 8-1. And what it says is this is an extreme condition. And when it reverses enough, that's a good stop. And for the next 5 to 30 days, you have a really favorable upward move that if you could work on a daily bar or even a 2-hour bar, you have a real advantage. So we're using that as like a long-term swing research project. And what we're looking at hard is the 2-hour bar, which is better than the daily bar, because the 2-hour bar gives you 3 pieces of information that the daily bar does not. So if the daily bar is this, yeah, I can see where the opening was, and I can see the close, and I can see the high, and I can see the low, but I don't know what the flow of the price was. But if I had the 2-hour bar, I get 4 2-hour bars. And what I would see is maybe the first 2 hours was like this. And then the second 2-hour bar was like this. And the third bars look like this. And then the fourth one looked like, I don't know, let's see, maybe it's like this. Now I get a feel for the opening, the middle of the day, the directionality of the middle, which was a surge and then a fail, and then a lower close. So now I get 3 or 4 good pieces of information from the 2-hour bars. Like I can feel that that's actually a turning point. And it's hard for me to get that same information in here. And with 2-hour bars, you can go back 30 days. And so if you have 4 bars times 30 days, you have 120 data points, which is plenty to get all of your statistical treatments and measures on there. So the 2-hour bar works pretty well. Now, when we start looking at a certain lenses and we want to use multi-time frame, you've seen us work with the 3-minute, 10-minute, 30-minute, right? Like fast, normal, slow. You can also do 10, 30, 2-hour. You can do 30, 2-hour day. You can do 2-hour day, 3-day. You can do day, 3-day, 9-day. You can do 3-day, 9-day, monthly. Now, if we're using, so each one of those is fractal. Each one incorporates the idea of a slow, normal, and a fast. If I was just using the blended monthly rebalancing, I'm waiting for the calendar month to be over and I'm making all my adjustments in here, right? If I'm doing pure swing trading with end-of-day data, I'm right here. So there's actually, you could add the 9-day and the 3-day lens to your BMR, and you could be doing turbo using those 2 time frames to improve your adaptability on the BMR. That is long-term position swing trading. You could do genuine slow swing using a 3-day bar, fine-tuning it with the daily, and then looking at the 9-day to get the long-term trend. That's very much like Alexander Elder's triple screen. This is one that I like, the 3-day, daily, and the 2-hour. I really like this one as well. This is what my advanced hybrid swing looked like. I was using the 30-minute bars, and then looking at the 10-minute for accelerated, and then looking at the longer term for 2-hour. So the point there is that by no matter which lens you use, no matter what frequency you're trading off of, you have the ability to use multiple time frames to give you this slow, normal, and fast advantage. And if all of your patterns are fractal, it's the same, but an SSC is always an SSC, no matter which particular multi-lens you're using. Now, if you're using those charts and the moving regression lines, now suddenly the look back period that you're using matters. Like if I'm using 30-minute, 10-minute, 3-minute bars, yesterday's high and low really matters a lot.
Yeah.
If I'm doing, 30-minute bars, the 10-day high and low is now my look back period of choice. And it might be the 30-day high and low. As I start moving further and further back, I'm getting a wider and wider or a longer look back period to establish the price levels that are in play. So as you know, if you look at my daily report, I put a lot of attention on the 1-day, the 5-day, the 10-day, and the 30-day. And so 30 days and in, to me, is tactical trading. So I always know where the yesterday's high and low was, the 5-day high and low, the 10-day high and low. Now here's why I use the anchored VWAPs like I do. The intraday VWAP is the intraday reversion to the mean. I use a 3-day to kind of get a front run on the 5-day. Here's the high, here's the low. What was the 5-day anchored VWAP look like, and where is it today? And then 10-day high and low, and there's the 10-day anchored VWAP, and there's the 30-day high and low, and maybe the anchored VWAP looks like this. So I always like to know where those price points are, the same way that I like to see the intraday VWAP for the intraday magnet. I look at the 3, the 5, the 10, and the 30 so that I get a feel for the guys who are operating on those time frames. What do they think the average price looks like over time? And then what is their psychology? Like if the 30 period anchored VWAP is rising, I know that they're still feeling positive. So even though price may have hit this and is coming back, if the 30-day anchored VWAP is rising, I feel like that's going to be a strong support level. And I'm ready for a COTA 2 bounce off of that. But if the 30-day anchored VWAP is like that, and these things start hitting collapsing dragons, dude, I am way short. So I went a little off the beaten path there, but I just wanted to catch you guys up to speed on some of the emerging thoughts in my head. And I also wanted to just share with you, we are just starting to crack the code on EdgeRaider as a back tester. And one of the powerful things was, after a harsh winter sell-off on daily charts, that when the z-score of MACD is worse than -1, but the slope is rising, meaning that it is reversed, pretty soon it's going to turn into the spring. And spring, after a harsh winter, is a good thing because I can have a very tightly, well-defined risk box, and then my reversion to the mean trade is back up into here, and it may go leg 1, leg 2. And like I said, the 5-day, 10-day, 20 and 30-day forward projection in all of these is 70% of the time it's higher than your entry price. That is such an important, you know what that is? That is a form of market classification, because it gives you actionable information right here based on the previous criteria. It gives you a reason to have a biased prediction about standard future results. 70% win rate. Yeah. We need to pay attention to those for market conditions. So the next piece of the research project is to take a look at SPY, just so you guys can see where this is heading. If I can now classify this using that MACD into something like fall, winter, spring, and summer,
Yeah.
I can tell you what the net percentage of the market is. I can now give you 50% of what the future looks like. The other ones being, when the market is in fall, what is XLE, F, K, all of those, what are they doing when the market is in the fall? And when XLF is in fall, winter, spring, summer, what are its 4 characteristics like? So now I can start pairing the market and the sector that I'm interested in, and I can now come up with a standard playbook like a football coach. What yard line am I on? What formation is the defense in? How close am I to the goal? So what we're going to do is take a look at that as a way to focus our lens on the components we trade, that begins with an appreciation of the market condition and the sector conditions, so that we can go look in the optimum bucket for the best performing trade frame. I still have to go in and do the trade frame and say, yeah, here's my risk box, here's my reward, there's my critical state. I still have to do that, but I'll be stacking the odds in my favor with market and sector tendencies. And it looks to me like it's, where is the MACD on the Z-score, and what is the slope? Because that tells you what the most current momentum is. Like if it's below -1 and the slope is down, you better be collapsing dragoning for all you got. But when the slope reverses, that's telling you you're into the territory of supported spring crossing, and then all the kata 2s all the way up. So we're setting up a pretty complex market research project with EdgeRater to do that. But we already know that this move on daily bars, 70% win. Harsh winter, positive slope. Done. Okay, back to you. Pardon me for stealing some time, but I wanted you guys to hear that.
No, all good. I work to do.
The rest of the community probably won't get that till January, till we've really sorted through all of the combinations and permutations. But that's such an important factor that I want you to get the extended version of that.
I was trying to stop sharing, but I don't know. My computer locked up. You guys stop.
Uh,
You're back to normal?
Not yet. Let me see if I can override you. If I bump you by sharing, maybe I can take her back to normal.
Yeah, mine is.
Replace current share. Try that.
Yeah, I think I'm gonna have to disconnect.
Yeah, no, hang on. I may be able to just bump you off. All right. And now if I unshare, yeah, we should be back to. All right. George or Jonathan, go ahead. First of all, any questions on any of the other things I was covering?
I guess I can go.
Okay, go ahead. Oh, it's yeah, it's not overriding Juan Carlos's. So let's go ahead and get yours going. And I allowed multiple screen shares, so I think we should be okay here. Okay.
Does that work?
Yeah.
Okay, so not much to report. I ran my system every day, except took most of Thursday off because it was announcement from the Fed. So didn't get any trades on Thursday. But we have 55 trades with an expectancy of 0.09.
Let's not forget these three.
Okay.
The three
So
story stocks that are just the future of America.
Okay, I guess I can test those and see which ones are working.
And if it turns out that PLTR is good, then PTIR will be even better. PTIR is it's an exchange traded note which returns 2x of the daily gains of Palantir. So all they do is track Palantir and return twice the result. So if Palantir is not volatile enough for you, PTIR is there. All right, go ahead, keep going.
Yeah, so I'll just keep running the system. I guess what's not good about it is it doesn't get that many trades. Looks like it's been 3 weeks. And so it's only getting about 15 or 20 trades a week.
Hey, what I'd like you to try on is get Phil's back testing parameters for that supported spring crossing strategy, the Z-score -1 but rising slope, and let's see if your back testing software gets the same results his does, because I want to be able to sort of calibrate these different methods of back testing.
Sure, I can do that.
Because that's one that does not require intraday trading and looks to me like a real good candidate for that longer term position swing trade, something that sits between swing trading and BMR. Because I think I'm going to have them tested on 3-day bars as well to see if it handles that like longer term position trade. That's the one where I think it would be something like 5 or 10% trailing stops. So a much longer term, buy it and let it run slowly but directionally after a harsh winter. What I want to do is, since I haven't personally tested Edge Raider as a back testing thing, I want to sort of calibrate what your system does and what Edge Raider does, so
Okay.
we can compare our tool set. I'm going to have Sundeep and Mark Holland do that with TC 2000. I think it has either that or Trade. I know TradeStation is a back tester, and I know Mark can do TradeStation. So I want to start getting some independent verification of our statistical edges. Okay.
Sounds
All right.
good.
Let's Jonathan, over to you, sir.
Well, last week we talked about me trading on the 1 minute chart.
Yeah.
And so I played around with that last week. My brother's been in town, so I've only traded a couple of days last week, but I set up some different charts and to look at those in real time while the market was open in YM. And I set up a 1 minute chart that had nothing on it but the candles. I set up a 1 minute that had my basic indicators. I played around with tick charts too to see what those look like. I'm not really
Pretty
sure.
fast. Those are pretty fast.
Well, they are, and picking out which how many ticks to use. I don't know that there was really any advantage.
Well, I monkeyed around with that with I was combining the ticks with Renko charts, anywhere from 50 ticks to 800 ticks. And it gives you long periods of time where nothing is happening because it's just droning along in a certain range. And then all of a sudden it'll run, and then it's like a tripwire. And you get a flurry of boxes in one direction all at once. And then it's like the Jack in the Box. You start cranking that thing and nothing happened. And all of a sudden the snakes come out, snakes in a can. My spider sense is that on something like the Dow Mini, the regularity of the timing box, it hits and then you get a new bar, you get a new bar, you get a new bar, that there's a certain goodness to that. Because it allows you to see, you end up discovering a sideways quiet channel.
Are you talking about with time or with
time? By having the standard time on there, if you get no movement out of the price band, then you get that long narrowing set of dojis sideways, and the Bollinger Bands compress, and you can see the time length that it was in that condition, and you can feel the spring compressing. The Renko box gives you no sense of that movement. All you know is it makes the time irrelevant. So you just know that it's in that box. It's still in that box, but you got no sense whether it just got into that box or it's been there for 2 hours. Now, the Renko box tells you when it makes a significant move out of that box, because now a new box is formed, and then off it goes. But without that sense of rhythm and timing, that's where your trade-off occurs. The Renko box, in my view, is well suited for trading multiple symbols at the same time, and you want to be on the one that's moving. So in a very real sense, find the mover. The Renko box finds the mover because the Renko box is moving. If it's not moving, the Renko box is stationary. So it's not moving. And then you can bracket that, with your red line and green line, so that'll, when it does break out and goes, boom, boom, you're in. So that's well suited when you're watching 10 things. You're watching 10 boxes and you're waiting for the rabbit to jump out of the hat. Which one? I don't know. It's going to jump out of one of those hats. So I think the tick chart, those are very, because what'll happen is it has to have a number of trades that hit either the bid or the ask before it fills up the bar and then creates a new bar. So it's the number of transactions that causes each next bar to go. And so the speed of trading varies during the day, which may be fine for individual stocks, because now you can see when the herd comes in and is really starting to trade, because now the bars are starting to happen. It may not
Well,
have moved out of the volatility band yet, but you can see that the activity has increased. But my spider sense is that on the big fat indexes that are trading continuously throughout the day anyway, that actually is deceptive in that sense. I think
Yeah.
standardizing on just minute or 3 minute and in the standard framing is fine for trading the Dow Dow minis.
Well, the rhythm, I think, was the operative word that you used. Is that it definitely felt better on the 1 minute candles.
Yeah.
And I think for our trading techniques too, I just, although I only tried it for a couple of days so far, it felt like for what we generally do, that the time charts seemed like they were better.
I think especially for the Dow, that is such a regular heartbeat of continuous trading that I think you're just better to track its vital signs on a time regular basis, and then just look at the change, and now you have a standard frame. Every time you look at the chart, you're always dialed in to what's going on. You don't have to say, well, how long has it been in that Renko box, and when was the last time it moved, and all that shit. So I just think it's when you are in constant contact with your patient, I think having the regular time interval makes the most sense to me.
Well, I like that. And a couple of the things that I noticed trading the 1 minute is with my standard indicators on the 1 minute, kind of watching the 1 minute and the 3 minute at the same time. The PSAR on the 1 minute is pretty close most of the time to where I would generally have gotten out on the 3 minute. So. And one of the days that I traded was the day that the Dow was in a doji, and so it just kind of went sideways and nothing really was working. And then there was another day made a really nice move. So I'm wondering, is the 1 minute going to give me, since I'm using an R10 risk box on both, I've got more room on the 1 minute. I can let it come back to the PSAR, my same position size,
and be relaxed. You're not overthinking it.
I'm not overthinking it, and it's so far it looks like it's going to be pretty close to where I'd want to get out anyway. Maybe I'm better off trading the 1 minute and having more precision. The other side of the coin is, am I going to end up over trading?
Think about the 3 minute entry so that you get a little more confirmation that it's moving. And then you get to no lose plus dinner for two. And then as it's starting to flow, everything's normal. Now, when you see it start to hesitate and that generates some mental wobbling, just dial down to the 1 minute for precise execution.
Yeah.
That way you're not living. If you're watching the 1 minute bars, that's what you're doing with your life. Well, I mean, because it's, what can you do for 40 seconds while you're waiting for the other bar to close? Hey, I have 40 seconds. I got all this time to, I'm going to start reading the book, and done. It gets you,
well, it gets really you earlier too. Like there was sometimes when on the 3 minute I wouldn't have entered, but it was a good looking entry on the 1 minute. And if I took those, I'd be getting 1R on a trade where I wouldn't have taken anything on the 3 minute.
Well, so that's where I want you to kind of, I believe that you are comfortable enough with what your normal behavior on the 3 minutes is like. And now you have a chance to examine the 1 minute where it's going to help you potentially is like when you're flying an airplane. The two most interesting times are takeoff and landing.
Right.
So maybe that's the time that I'm using the 1 minute to improve my entry, and then let the 3 minute fly it until it starts to get wobbly, and then dial down to the 1 minute for the exit.
Well, the time that you just mentioned, that's something that has really stimulated me to think about this much more this week, because I really only need to make if I made 3R a week, I would be perfectly happy. I think I can do much better than that.
Yeah.
And so if I'm trading 1 minute, I don't need to sit there all day and do it. Maybe I just need to, if there's a run that day, take what's there and I don't have to keep trading and giving
You
it
know,
back.
my sense is on the
Stop.
Dow, on the days where it makes a nice run, say average range or higher, 80% of the time that run happens in the morning,
Right.
in the first 2.5 hours. Yeah, is it possible that there are days when the Dow in the afternoon makes a run? Yep. Like on Fed days, yeah. So maybe you do something special on Fed days. But 80% of the time, the move that was there occurs in the morning session because it's responding to the overnight trade and the news of the day. And then once it's done, those guys just go home, and all that's left is a little bit of tactical noise, and it just flutters around and grinds you up. So if you were going to kind of commit to that, to be there for the prime time, to me, it's the first 2.5 hours of the day. And then it's up to you to decide how close to the open you want to trade. How much time am I going to let it go before I participate? My spider sense is around 10 to 15 minutes. Is I like to see 10 minutes of stuff. The only time that I get faster than that is when there was already a big gap. If it's the big gap, I'm ready to go right from the opening with a bracketed R10 because the next move is going to be large right away. But if it's a normal opens approximately where it closed, I can do the OR10 and just be happy with that. Trade the first 2.5 hours. And
I would be very content to do that. And if I'm trading on 1 minute, and if I find that I'm managing it so that I'm getting some greater precision, and I'm getting, and I get a couple of R that I wouldn't have gotten trading on the 1 minute based on how that chart appears, I can take my 2R and trade for an hour and a half and be done.
Yep.
And some days maybe I won't get anything, but
that's a good psychological accommodation when you realize, hey, that's all I'm trying to do with that particular golf club on the golf course. I'm just trying to get that piece, and I've got other systems in the other time frames to handle other parts of my portfolio. But I'm getting
to work on those and develop those.
Yeah, and we got enough guys working on the swing and the position size or position trading that leveraging the community of practice for that is there. Like Bill Scheit's PRX system and the swing PRX, and what we're going to develop with what I talked about with Phil's research. I mean, Hamad and Chi Weng Chong. Chi Weng Chong is a machine right now for his intraday. And he's going to turn that into, he's also now starting to look at the swing trade because he's got that thing pretty well on autopilot for what he wants the intraday to be. 3 minutes with Kata twos and collapsing dragons. That's what he's doing.
That's all he's doing.
Yeah. On, I think, 5 or 10 symbols. But it's stabilized to the point now where he's looking into the swing trade piece. And that seems to be an area where a lot of us are looking at now, like Sundeep and Mark Holland are looking at that. And so, stay tuned to the community of practice. That's the whole idea. That what I was describing at the start of this was you get 20 guys that are doing individual tuned research, starting with a standard preparation, the foundations of how to think about the trading and the language we're using, the patterns we're looking for, and then sharing those results across 20. You're doing one good unit of research on your particular research question, but you're getting the payoff of 20 independent researchers on a continuous weekly updated basis. That's what the small group coaching concept and cohort approach is achieving. That's the way that's shaping up. I'm ready to do. I really am not all that interested in the one-on-one coaching, although I can charge a much higher fee for that for my time. I would much rather watch 20 guys working together as a platoon, and help guide and shape that, because there's DNA robustness in that. All right. So there's some ideas in there for you to check out with Chi Wing and Hamad. Just news from Hamad. I mean, he's working with a Canadian money management firm that's hiring him basically to do the COTA 2 challenge on 3 futures contracts, the S&P, the NASDAQ, and the Russell. No, the S&P, the Dow, and the NASDAQ, but in the pre-market and post-market, because it looks like those kinds of strong after-hours moves that create the big gaps look like they are independently tradable in those time frames. So you get out of that trade as the market's getting ready to open, and then experiencing the gap, and then the explosion after the gap is a reaction to what was a real strong move in the overnight session. So he's gonna, because he's in United Arab Emirates, being able to trade the off hours is a much better alignment with his regular living day, his time zone.
Was that
So,
you'd sent out an email that you had discussed some futures trading, I think, with that. Was that what you were referring to?
Yeah, because he and I gave a little short summary about what I didn't want him to do was to try to trade the pre-market continuously through the open, then right into the next, opening 2 hours of the day, because those are really 2 different psychological sessions with different market participants, way different volume. The pre-market is all front running and posturing for the response that happens after and it's not predictive of the direction of the next day. It's like, hey, the pre-market was all straight line up, so I'll just buy it and hold it. And no, it's just going to be a big gap up, and it fades back to the previous VWAP, and you get crushed. So there's no directional predictive value in the pre-market to the after the open.
You mean like the first hour or two pre-market, like in the morning? Okay.
Yeah. The 2 hours before, or the 4 hours in his case, the 4 hours before the market opens, the futures markets are grinding along, and where they end up is where the market is going to open. So if there was a strong directional move in the pre-market, that's going to manifest as a huge gap when the New York market opens. And then we know that large gaps predict large follow-throughs the rest of the day, but not the direction. So you have to understand that difference in order to ensure that you don't get caught up in your beliefs and success of hey, in the pre-market trade, I trade a long trend following thing and it paid off 4R. Good. It's going to just keep going. I believe that. Well, no, you just know that right after that big 4R gap up, there's going to be an explosive move. It's either going to follow through or it's going to fail large by the end of the day. I don't know what direction. It's not predictable. So it's still possible to, I mean, I love trading on days that started with a big gap, but I like to see the smoke clear and then see which way it's going and try to tune into that as quickly as I can with an OR10 or an OR3 or something. So the discussion I had with him was about that phenomenon of the difference between the pre-market session and the open for those three indexes.
Okay, I'll go listen
because there's no piece of news that's going to suddenly turn those 3 into an asymptotic move, unless it's like, oh, surprise, Donald Trump, welcome back, asshole. Then,
well, I wondered about that, because sometimes you'll see the pre-market, it'll make this nice run up.
Oh yeah, and then there's a big gap, and then they just fade it and crush it
and then
back
opens,
into
get these crazy candles.
Yeah, because
that all through the open.
what that is that the guys in the pre-market overseas are trading where they think the news is pointing. They think everybody else is going to react to the news in a certain way. So and then that starts building, starting to get momentum trades, and I must really be right. And then the guys next morning say, hey, we looked at the news, there's nothing there. Oh, look at this, it had a huge gap up. Great, we'll fade it back to the VWAP and kill the hopes and dreams of all those pre-market traders. Love it. The market feasts on the shattered dreams of naive traders. So,
of the VWAP, if I could ask you one more question, I didn't put the VWAP on my 1 minute charts and the Bollinger Band.
Yeah.
Is the value to going ahead and having it on the 1 minute chart?
The VWAP that's the beauty of the VWAP, regardless of the time of your chart of the bar. The VWAP is always the VWAP because it's calculated continuously. The volume times the price is each next trade causes the VWAP to get recalculated. So the later in the day you get, 1,000 shares traded in the morning could move the market a lot, the VWAP a lot. But later, after 10 million shares have traded, you get one more trade of 1,000 shares. It's going to make it reduces the volatility of the VWAP proportionally. So you get a lot of movement and then it settles in, and then the VWAP is the VWAP the rest of the day. Unless guys come in at the last couple hours with massive amounts of money and start buying it or selling it far away from the VWAP, then they can keep it away from the VWAP. It'll close significantly away from the VWAP. When that happens, and it's rare, that's always a warning sign of changes in the worldview.
The wick can still function as a reversion target on the 1 minute.
Yeah, it's always the VWAP is always the VWAP intraday. I think it's even better on the 1 minute because you can get onto it quicker.
Okay.
All right, that's all I got. I need to get the reports done and off we go. I got a clean bill of health for my cardiologist. My LDL was under 100. Resting pulse rate was 60. Blood pressure 120 over 80. He listened for a couple minutes. It's performing like a champ a year and 2 months after the surgery, so all is well. And good to go. So perfect. All systems go. All right, take good care, guys. See you soon.
Appreciate it.